Hello, everyone. Welcome to another episode of In Conversation by Advisor Coach. Today, in conversation, our very dear friend and a dear guest, Mr. Abhishek Tiwari, Chief Business Officer with PGIM India Mutual Fund. Abhishek, a very warm welcome once again to In Conversation with Advisor Coach.
Thank you, Suren. Thank you for having me. And it's always a pleasure and look forward to this interesting conversation.
Always a pleasure here as well. So I think we are having this in conversation today at a very interesting points in time in the markets, right? As we speak, markets are cracking today. And of course, yesterday's event of the reciprocal tariffs, by Mr. Trump, of course, have kind of disrupted the markets across. So when we look at these kind of market behavior, seeing a lot of highs and a lot of lows, uh, in the recent past 4 5 months, and we see them today as well. And investors investing through SIPs, their returns, in fact, for about a year have gone negative. So, what would you suggest investors, during this high volatile time period?
Yeah, so Suren, to start on a lighter note, I think while we are doing the interview, I'm sure a lot of news time is being taken by Trump. So I do hope a lot of people watch this. But at the same time, I think a very critical question, Suren, and I think being a part of this industry long enough, I think one of the questions that we kept on asking while the SIP book was building up was the fact that what happens when 1 year returns start looking negative, or maybe a little longer start looking negative, and we have seen these phases before. There are two aspects to it, and let me break it down. First of all, to say how have we seen the behavior. One is we have seen closures across the industry. I think that's a number which everybody has. But let's realize that after knowing that more than 50% of the investors have come in only post-COVID, and while they have only seen a one-way ride, seeing a closure of maybe less than 10% of the outstanding book, even while seeing such a vicious volatility
Mhm.
for the last, let's say, 3 months or more, um, I would not read too much into it, right? Furthermore, if you break it down and you see it from the lens of channels and non-channels, you will realize that channel-led SIPs have not even broken that much.
Mm.
It is a lot of do it yourself, where I think either it may be closures because the experience has not been great, or it may be because they may be in some category and they want to shift the category because they realize the fortunes of those categories are no longer the same as they expected. But while I'm saying all of it, I think it's very important to realize that one, SIP is a very effective and a very much uh, you know prominent tool to participate in the equity market, or the journey that you are planning for achieving your goals. And let's face it, what are we going through? So
Mhm.
I think the volatility is to a large extent, or the downside is to a large extent self-inflicted. When I say self-inflicted, it is that we are coming off an election year. There was literally a 4 to 5 months freeze on any kind of spending. I think for everybody, if you were to just look at the components of GDP, you would realize and appreciate that a large part of our incremental earnings are based on central government spending, and that's been the pattern for long enough. Uh, but there are other parts of this which have started firing. The investment growth, or the private investment growth, or let's say corporate profits to GDP, which are very important components of how do you literally make returns or the outcomes that we look forward to. I think all of them have started taking.
Right.
At the point of COVID, corporate profits to GDP had dropped to 1%. It is now at 6,
Mm.
right? All-time
Interesting.
high have been 7.
Mm.
So let's realize there is a lot of good things that have happened, a lot of good outcomes that are built in. And when you suddenly hit a roadblock like 5 months of spending freeze, you are bound to have a downturn in earnings, and that is bound to show on the sentiment of the market,
Right.
right? The good news is the spending has restarted. I think
Mm.
starting December or
Yes.
January
The
is when
numbers
I
have
speak.
started picking up.
Yeah. So
Right.
when I speak to my investment team, I think they tell me that the spending has not only started, it's very benign, and it's growing very fast. Um, Also, the good news is that when you look at it from a balance sheet perspective, I think the health of the balance sheets for corporate India is extremely clean and
Absolutely.
extremely strong, which means that as and when demand keeps on showing up, they have the potential to keep on responding to that demand without really worrying about leverage or or any kind of collateral cost which can bring down your returns from your equity investments.
Very true. Yes.
So the reason I've given a longer answer, Suren, is because let's realize that what are you participating? You're participating in this asset class, and I think if it pans out the way we are expecting it to pan out, then I think stopping SIPs or pausing SIPs or worrying about that whether I've done the right thing is possibly the biggest mistake that
Hmm.
an investor or an advisor can do. Uh, the other aspect which I think I would allude to, and I we did from a PGIM perspective come out with a paper which kind of repeated what a lot of our industry participants have said for the longest period of time, which is to say that don't miss the best days of the market,
That's right. Yeah.
right? Now, the reason why we rewrote that paper is to highlight and make people realize that it is not as easy as it is made out to be, because most of these mistakes are made in highest volatile times, like the one that we are in right now, or like the ones that we have experienced in COVID, prior to COVID, and so on and so forth. And the reason why that is important, Suryan, is that 60% or more of the best days are very tightly clustered with the worst days,
Hmm.
right? So in volatility, if somebody starts feeling that, oh, you know what, let me stop my SIP, let me pause my SIP, let me sit on the sidelines when things are looking good, I'll come back to the market. The cost that you will pay is missing those best days, which not only mean that your goals get delayed, but your experience of the investment takes a beating.
Very true. Very true.
So combining all of what I've said, Suren, I would say that one, I think people should not really worry about these kind of bouts of volatility.
Hmm.
The structural story remains intact. I'm very conscious that I'm making that statement in the midst of what's happening globally.
Mm.
But let's also realize that a lot of things have changed at a very macro level. One is in the earlier times, let's say if you were to dial back 5 years and 7 years, you used to be speaking on behalf of an economy which used to be about a trillion or maybe a little over
Hmm.
a trillion.
Right.
Today we are over 4 trillion. Marching forward very smoothly towards a 5 trillion. Um, our GDP growth rates on a real basis are between 6 to 7.
Hmm.
If you look at a nominal number and proxy that with corporate profits, then those numbers look like anywhere between 10 to 12 or maybe a little higher than that.
Yes.
When you put all of this into context with our economic background of 4 trillion plus, you suddenly realize there are not many economies, in fact, only a handful, which you can count on the fingers, which would be anywhere closer to this.
Absolutely. Absolutely.
Um, and even if tariffs was to derail the global growth story a little bit, let's realize that there is capital which will chase growth. And,
Absolutely.
and we believe that we are very well positioned to be able to capitalize on that.
Great. Great. Great.
So the request and the submission will be that please do not worry about bouts of volatility. Concentrate on the longer term picture. Make sure that you have your goal in mind. Make sure you do rebalance if at all there is something wrong in the portfolios that you have chosen. But please don't stop your journey by pausing or stopping your SIPs because the volatility has hit an outcome in the very short period of time.
Very well. Very insightful. I think this one should be well heard by all investors and our distribution partners. A very important one. Abhishek, when an investor is making an investment decision, it's often seen that they look at the point-to-point return.
Oh
Now,
yeah.
in the fund category, scheme category, they're looking to invest in. So is that right? Or is a rolling return a better parameter to analyze before making an investment decision?
No, absolutely. So, and I think this question does get asked very often and more so in the recent times, even more. Let me again give you some quick data points. I think let's realize that more than about 50% of our incremental sales over the last 18 months of the industry has happened into segments like thematic and sector.
Mm-hmm.
followed by small cap, and so on and so forth. Uh, Second data point that I should give to you is the fact that at this juncture, standing right in the beginning of April, and if you were to rewind just by a week or so, 5 years trajectory sits right at the point of the COVID drop, which means that the base was too low. And suddenly, if you start looking at your return experience, you would start seeing these segments that I highlighted to be anywhere between 40% to higher compounded return, right? Now, this does not just confuse, but this also results into an expectation which cannot be, uh, you know, uh, cannot be fulfilled from a future perspective. And that is exactly why rolling returns becomes a very, very important criteria to be referred to, not only from an advisor community perspective, but also specifically from an investor's expectation setting perspective. What is rolling return? Rolling return is essentially a real experience of an investor who would have participated in the market and seen that market on a daily basis.
Right.
Point to my point gives you a very hazy picture.
Yes.
And generally, the way our brains are wired, you always want to look at the good.
Mm.
While जैसे हिंदी में बोलते हैं अफवाह जल्दी
Mm.
फैलती है, वैसे ही पॉइंट टू पॉइंट रिटर्न अगर आप आज 5 साल का बोलेंगे तो 5 साल का रिटर्न 40% बहुत ही इजीली फैल जाएगा.
That's right.
लेकिन अगर हम उसी चीज में सुरेन, if we were to essentially to start talking about a real expectation, I just mentioned about corporate profits, being at possibly 10 to 12% or maybe just a little higher. And maybe if it's a very smart investment manager, then he will be able to add some alpha to that. So expecting 14, 15 percent or maybe higher depending on different capitalizations is a realistic estimate to have. But 40% and 50%, no science or math can really explain that.
Absolutely. Absolutely.
So,
Really
so
living
I,
on future borrowed returns, I must say.
Absolutely, absolutely, sir. So the way I will submit on this, rather than keeping on talking about it, because you can
Mm.
obviously keep on talking on this aspect for long, is
Mm.
the fact that rolling returns gives you the real picture of what you can achieve from your future investment,
Mm.
with obviously, the realities of today impacting those returns either positively or negatively by a little bit. But on a point-to-point basis, let me assure you that you will be surprised dramatically, specifically if you are in a scenario like today, to start looking at last 5 years and saying, oh, 40% is what I can possibly achieve.
Mm.
Not happening.
So, a very interrelated question is that how do we manage this investor, expectations, right, as we go ahead?
Yeah. So I think what is important, Suren, and I think that is exactly where an advisor's roles become paramount. And specifically an extension to that is us on this side of the industry. It's very important to bring out the basic benefits of not only diversification, but also the choices of funds, the different categories, and hence the opportunities, and then also making sure that people understand what
Mm.
compounding is all about, right? A 15% compounded return on a very short basis looks a very small number, possibly in context to what we just spoke about. But 15% compounding can literally, double your money in 4.5 years,
Yes,
right? And the next doubling will happen subsequently much faster.
even
And
much faster.
will
Correct.
so the whole point is, I think, making sure that investors recognize and appreciate some of these basic benefits that all of us know in the industry. It's nothing new that I'm saying, but going back to the basics, carrying hard data, being brave enough to tell them that you are speaking for their benefit. Uh, I think is very, very important aspect of how we can do expectation setting. I must also qualify whatever I'm saying by honestly telling you that all of our advisor partners, and a large part of them, when we have been meeting them for the longest period of time, have not really uh, proactively endorsed a theme or a sector becoming a large part of an investor's portfolio. But the kind of feeling of missing out that got created in the market, combined with the fact that prices were moving faster and at the same time narratives were moving way faster, made sure that a lot of investors just kept on adding to most of those narratives and hence sectors and
Yeah,
themes.
a lot of tailwind.
It may be not at the cost of going back and rubbing the wounds, but making sure that you go back and restate the realities, restate the expectation settings. And I'm sure our advisor partners, friends are, very, very close to their investors, to be open enough to tell them that you can achieve the same if you keep discipline and just focus on what is actually achievable, which is the 12 to 15% compounded return range.
So true.
So I would say, yeah, it is going to be it is going to require some kind of a braveness to be able to do that.
Yes.
Not going to be easy, but at the same time, that's exactly where our roles are. Because when the market is doing itself, I think everybody will tell you, market ne kiya, aapne kya kiya. Uh,
Mm, mm.
so it's important that we play those roles.
So, any particular scheme, Abhishek, which you believe is a great scheme or a category for SIPs? And do you believe that global funds are making sense at this point of time?
Oh, absolutely, Suren. So very, very relevant and interesting. And I have a little bit of a different approach to this. As I started by saying that I always have looked, and I always tell people that please don't look at SIP as a product. I think our industry has made SIP a product, but SIP is essentially a tool to participate and navigate through the whole journey of wealth creation, goal planning, and so on and so forth. So I would say, for each investor, it will be a different approach. But having said that, if I have to still choose one fund, I would go with a flexi cap.
Hmm.
But for different, risk appetites, for different approaches, I would say SIP is a very, very elegant tool to participate into different categories of products and hence different market capitalization, owing exactly to your risk appetite. And I think for that, you should consult your advisor, as well as distributor. They will be able to plan that better. But the point that you mentioned, Suren, is very relevant, the global allocation. And I think, till the point India doesn't become a very, very large part of the global economy, um, nothing to take away from the opportunity that we have in terms of absolute return. Let's realize that a lot of innovation engines, lot of fast growing macro themes are still sitting and panning out in economies which are outside India. India still is between 3 to 4% of global market cap, uh, and very, very similar on the GDP as well. Which means that in very, very laymanish terms, if you were to understand this, 95+% of opportunities are still sitting outside India. Now,
Right.
what could be those opportunities? Those opportunities could be technology driven. Those opportunities could be, size driven. Those opportunities could be unique market driven, and so on and so forth. And I think having a global allocation, and again, to each his own, but maybe a 10% average weight in your portfolios of having a global allocation solves for not only a single diversification of a market and an opportunity, but it does give you a second level diversification of currency. And hence, I would say that for every investor, maybe not for starting ones, but for every other investor who has a portfolio, there is a very, very important part of allocation, which is global allocation, which should not be missed.
Sure, sure, sure. So about 10% is what you're looking at, should be sort of a suggested
And
allocation towards these kind of funds.
okay, so since you have asked that, Suren, let me just elaborate a little more on that. I would say 10% is the starting allocation.
Right.
But depending on your goals, so for example, if your children are going to study out abroad, if you or any of your family members are going to be relocating to outside destinations, then obviously, linked to that, your larger part of the portfolio should be shifted towards global allocation.
Mm-hmm.
But if you're basic, simple looking at diversification as a tool, then I think starting with a 10% allocation and depending on what your risk appetite is and what are your components of the portfolio, I think it can be deliberated upon.
Sure, sure, sure. Thanks for that. So, Abhishek, what message would you like to give to investors, advisors, mutual fund distributors about opportunities arising through, let's say, sector, team and style rotations?
Okay, so let me restrict myself to speaking on how we think about it,
Mm-hmm.
and I'll tell you the way we have gone about building our business. From 2019-20, prior to that, we were literally a fixed income fund house, and we have grown. We have literally changed the entire nature of our business to an equity fund house, with over 90% assets being in equity funds. Um, but the road that we have chosen is not through launching just new funds, and specifically not launching new funds at the time that they were either popular or were in fashion.
Sure.
Uh, so if you look at it, what did we do in terms of funds? We did the Balance Advantage in 2020.
Mm-hmm.
We then did a couple of uh, one global fund, which is a global select real estate, right at the cusp of the turn of interest rate, because we believe REIT, and specifically a global REIT, does respond to that reality very well. Then most recently, we have done an healthcare fund. And the reason I quickly brought it to that, Suren, is that in this whole, sea of people launching sector and thematic, we only choose healthcare as a theme for two primary reasons. One, that we believe that healthcare as a theme is not as slim as a sector, but it is a broad-based theme with multiple legs.
Mm-hmm.
What I mean by that is there is drug manufacturing, there is drug exports, there is hospitals,
Mm-hmm.
there is there is diagnostics,
Yes.
there is
Yeah.
medical equipment and supplies,
Mm-hmm.
there is contract manufacturing, which is the CRO CDMO space, which is fast growing. So even with the number of things that I've already mentioned, you and all the viewers would have realized that it is a broad-based themes with multiple legs, which are not so interconnected.
Sure.
Right? Second is it is a very small representation in our benchmark index, and more so even in the 500 representative companies. So let me name that number to you. In the benchmark index, which is Nifty 50, it only has one company represented from a healthcare domain perspective.
Mm.
And
Yeah.
in 500 companies, there is only about 4% weightage for healthcare as a theme. Now, we at PGIM believe that, for a theme which has so many different legs of growth, for a theme which also depends on the fact that consumers, specifically post-COVID, are realizing that, they not only want to focus on the betterment of their lives, but also take the best possible treatments for the ailments that they or their family members may go through. Uh, the disposable income is playing a big role in terms of how healthcare is expanding. Uh, Combine that with an underrepresentation in the benchmark index makes full sense for launching a separate product so that they can participate and make sure that the misrepresentation in the benchmark index is
Sure.
made up by their active choice of participating in a fund like this. So what I will leave as a thought, and I don't want to speak for the entire industry because everybody approaches their business differently and they have their
Yes.
clients to respond to. But at least we believe that if you focus on the average experience of your investors, um, I think not only will their trust go up, but at the same time, the longevity of their investment and hence the outcomes, which will result in good experiences, and hence repeat purchases will go up. And that's the kind of choices that we make here. I don't want to speak on behalf, or I don't want to literally give a sermon to how you should do it or should not do it, but this is the way we approach it.
Great, 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 great. So, well, for our viewers, this is Mr. Abhishek Tiwari, Chief Business Officer, PGIM India Mutual Fund, sharing his views on the markets. And I think it's very bold to come out at times like this and talk about what to do and what not to do. So Abhishek, thank you very much for sharing all these valuable views and taking out time for this in conversation today. Thank you very much for joining in.
Thank you, Suren.
Thank you.